we're very happy to welcome Philip Clarkson, who's going to tell us about foreign exchange.
So, hi everyone, thanks for coming today. I guess I should just start by introducing myself. My name's Philip Clarkson. I work in the Market Analytics Group at BNP Paribas in London in fixed income research. I've been in this role now for approximately 2 years. Prior to that, I was working in the field of computer speech recognition, starting out getting my PhD in the engineering department down the road on Trumpington Street. And then I worked for a couple of startups. I made the transition into finance, like I say, a couple of years ago. Now, the reason I'm here today is to discuss a data set that we at BNP Paribas are making available to the Newton Institute as part of the program on statistical methods for high-dimensional data sets. A couple of months ago, Nick Brown, who's my boss, was approached by Chris Rogers, who wanted to talk to him about the program of high-dimensional data. And he wanted to ask him if there were any data sets that we might be able to make available to the researchers in it. And at around that time, I'd been working on the database that I was going to talk about today. And I'd been telling anyone who would listen that the way we were looking at the problem was wrong, and that actually what we were looking at was a machine learning problem, albeit a machine learning problem in a very high-dimensional space. So when Nick got this email from Chris, his first thought was the data set that I was working on. And as part of making that data available, I was asked to come here today to give a talk to introduce it and talk about some of the key features of it. So that's what the talk's about. I'm quite keen to stress that that's really all that the talk is about. I'm not, like Ewan earlier, I'm not going to get involved in any of our analysis or research into the data set. I'm merely going to introduce the data and introduce the problem and hope that it piques people's interest. So just to sort of give an outline of what I'm going to talk about today, I'm going to start by outlining the type of work that the traders on our Spot FX desk at BNP Paribas do, and what problems they face in that role, and what sort of problems that they were hoping that we in research might be able to help them with. I'm going to talk about the data that we have that we might be able to give us some insights into this problem. And finally, I'm going to talk about the way in which we've started to analyze this data and why I think that this is a problem that belongs in the realm of high-dimensional data sets. Okay, so what's the problem that we're interested in solving? Well, this is work that came to us from the Spot FX desk at BNP Paribas. They act as a major liquidity source in the Spot FX market, which means that they see a lot of deals. They see what their customers are up to. Now, at one level, this should enable us to sort of understand our customers better. And this is sort of a universal point. It doesn't matter what industry you're in. If you understand your customers better, you're going to do well. Because if you understand your customers better, you offer them better service. This is true across any industry, the obvious example being Amazon, who spend millions of research dollars understanding when and why people buy things. But in addition, this data might give our traders an insight into the market in general. At one level, that might just be to give them a sort of more general intuitive feel about where the market's heading. But as statisticians, we're interested in, here's a big database. We've got this database of deals. We've got this, or the price time series of the type that Ewan was talking about earlier. And we're interested in whether we can do interesting analysis on this database to address the problem in a more rigorous way. Now, before we start attacking the data, it's important to just sort of understand some key features of the way foreign exchange markets operate. I apologize to anyone in the room for whom this is very, very familiar material, but I think it's important to set the scene. The key point here is that FX markets operate in an over-the-counter fashion. That's as opposed to being traded on an exchange, like the futures contracts that were discussed earlier. If things are traded on an exchange, then the trades that can be done are much more standardized. Those trades can only be done when the exchange is open. The exchange is responsible for publishing the best bid and ask price that's available to buy or sell any particular asset. And the exchange matches buyers with sellers. Now, in an OTC market, like the FX market I'm talking about today, none of that happens. What you have instead are just these sort of multiple liquidity sources. People like BNP Paribas quote bid and ask prices into the market. They'll do this over the telephone if people phone up asking for a quote to trade currencies. But increasingly, and particularly with smaller size deals, this happens over electronic channels. Now, sort of a result of this is that at any given time, there's no sort of single rate to buy or sell US dollars. All you have are the prices that each liquidity source is prepared to buy or sell at. those prices won't ever differ very much from each other. But when you're looking at FX price time series, it's important to understand the sort of data you're looking at. Maybe you're just looking at the best bid, the bid and ask that a particular liquidity source has been offering. Maybe you're looking at an aggregated view. Services like Reuters and EBS provide an aggregated view into the market where they summarize the bid and ask prices for several liquidity providers. Or maybe you're looking at the prices at which trades were done. Another feature of the OTC nature of FX markets is that it's a 24-hour marketplace. If there's no one in London who's awake to trade with you, then there will be someone in New York or Singapore. It's really only at weekends that trades don't happen. So like I say, as a market maker in the foreign exchange market, BNP Paribas quote bid and ask prices for a range of currencies. There's actually no legal obligation as a market maker in FX to continually quote bid and ask prices, which is different to what goes on in things like gilts or in equities, where if you're a market maker in that space, you're obliged to offer bid and ask prices while the exchange is open. And mostly these quotes are provided over the telephone, and in general, larger deals are always done over the telephone, but increasingly we'll stream prices over electronic channels. Now, the risks that traders are exposed to when they're operating in this market are very easy to understand. If customers accept their prices, then they can build up large positions in a particular currency, and then they're exposed to the risk that that currency might change in value over the short term. Now, how are you going to manage those risks? How are you going to hedge those positions? Well, you might decide not to bother. You might just decide to hold the position and believe that the market is going to move in your direction, or it's not going to be very volatile. Or you might decide to sort of hedge the risk by offsetting it with a different trade. And how are you going to decide how to do that? Well, it's difficult, but the one thing's for certain, which would be very, very much easier if you had a good view for where the market was heading, what's going to happen next. By that we mean not just obviously predicting up and down movements in the market, but also changes in volatility. Now, as I said at the start, this work is really concerned with knowing our customers, understanding our customers. So who are they? Well, the deals that are done with other large banks, but they tend to be phoning on behalf of their customers, who would typically be the guys I've outlined here. There'll be hedge funds or asset managers, there'll be like pension funds, etc. And then maybe corporate clients or people in the retail space. Now, why are these guys involved in the market? Well, a lot of the time they're hedging currency risks that are inherent in their business, or maybe they're hedging options positions that they hold. But at a simple level, many of the customers are simply speculating on the direction of the market. It's important to understand that these customers can be having wildly different time frames for making these predictions. So there may be some people who are looking at very, very short-term technical patterns to try and predict what's going to happen in the market over the next hour, or the next few minutes even. And conversely, there'll be other people who are looking at sort of the economic conditions and are prepared to wait several months to be proved right. Okay, so just to give a general sort of view for what the market structure is. Our role is as a market-making bank. You see us there on the left. We can trade directly with our client banks, but we'll also stream prices through other channels, which you see there. There are services like Reuters and EBS and multi-bank portals who collect prices from several sources and provide an aggregated view. And similarly, there are single bank portals whereby BNP Paribas will just stream quotes directly to their customers. And many of our customers in the corporate and retail space trade with us through those channels. Larger trades with people like asset managers and hedge funds, they're done through prime brokerage. Okay, so we have this database of all our FX transactions. And this should give us a useful insight into our customers. The question is, well, what are we going to do with this data? I've alluded to these 2 points already. The first is that we want to understand our customers better so we can offer them better service. But we're interested in more than just building a profile of individual customers. We'd like to be able to classify or cluster our customers so we can build a view of the market as a whole. And the second point is that we care about risk management. And we want to know if there's data contained within this data set that would allow us to do a better job on that front. With these being our aims, what can we be more specific about the questions that we want to answer? So for example, we might be interested in whether we can classify or cluster our customers in a particular way. Maybe there are some customers who react very, very quickly to changes in market conditions or to news announcements. When Bernanke cuts interest rates by 75 basis points, maybe there are some customers who are really, really quick off the mark and trade instantly. Maybe conversely, maybe there are a different set of customers who are just a bit slower off the mark, who will make all the same trades as those guys in the first category, but do so a few minutes later. And maybe we can predict the customer flow that way. Can we maybe identify the sort of style of investing strategy that our customers are deploying? Maybe we notice, for example, that after the value of a particular currency goes up, there are a set of customers who instinctively just buy that currency in enormous quantities because they believe in sort of momentum trading or trend following. Conversely, maybe there are people who are doing the opposite because they believe in mean reversion. Maybe prices breaking through a sort of a 30-day moving average prompt a lot of people to trade. At a more blunt level, are there just simply customers who seem to be winners, who seem to time their trades uncannily well? If that's the case, that's definitely the sort of thing we'd like to know about. And of course, the ultimate question for us is can we predict what future market movements given the data in this database? Okay. Now, here's the key problem with our database. Our customers can go off and trade with dozens of other counterparties. Now, what that means is that we may only see 5 or perhaps 10% of our customers' trades. That makes it very hard to build up an accurate profile of our customers' activity. Even at a straightforward level, when a customer trades with us, we don't know whether that's a customer opening a new position or closing out an existing one. So even the straightforward question of, well, is this a successful trade? We don't know. And we'll never really know, what our customers' holdings are at any given time. So that's the challenge we face. We see only a partial view of the data. Okay, so those are the kind of problems that our spot FX traders are interested in. Let's talk now about the sort of data that we have that might help us work on those problems. I'm going to draw a distinction in this section between the data that we capture at BNP Paribas, which is kind of the whole database, if you like, and the data that we're making available as part of the workshop, the program on high-dimensional data sets. Clearly, there's data within this database that we consider to be sort of market-sensitive information and that we need to take steps to sort of obscure or remove from the data. Okay, so the sort of details we collect when a trade happens are all the details that you'd expect. The only field there that really needs any explanation is the timestamp. I mentioned that trades can be done over the phone or through electronic channels. When trades are done through electronic channels, we can obviously assign a very, very accurate timestamp to that trade. Trades done over the phone, however, we're reliant on the trader who's done the trade to manually enter the details into the database. And, they're normally pretty good about it and they'll do it within a minute or two. But, they're people and they get busy and other people phone up asking for quotes. And so it's not always the case that those timestamps are 100% accurate. And so when you're trying to align what's gone on in the database with the price time series where prices are quoted fairly accurately, it's not always easy to line those things up. Other than that, I think the fields that we capture pretty much speak for themselves. Okay, so in making this data available to participants in the program on high-dimensional data sets, we face a difficult problem. It's a balancing act. On the one hand, we want to release a data set that's interesting to people, that people want to pick up and use, that they can do cool, interesting research from. On the other hand, like I say, there is information in there that is sensitive and that we need to take steps to anonymize, to obscure, or just to remove. A most obvious example there would be the identities of our customers. And we can straightforwardly just take any string in the database that refers to a customer or a counterparty and replace it with an integer code. That's easy. We could go further. We could add noise to the timestamps or to the amounts that were traded, or we can just sort of randomly subsample the data and only release a fraction of it. The further you go down that route, though, the less interesting the data becomes, the less useful it becomes, the less relevant any research findings are likely to be. So that's the trade-off we face, and I hope in the data set that we're releasing, we've got the trade-off right. I think if we've got the balance wrong, we've probably erred on the side of being slightly over-conservative, but we can discuss that. So just to outline what we've done for the data set that I'm talking about today. Naturally, we've replaced any string that refers to any entity in the database, like a customer or a counterparty, by an integer code. So, at the obvious level, that means that you'll be able to see that a trade was done by customer 42, but have no way of identifying who customer 42 really is. Also, we're going to round all trade quantities to one significant figure, which I don't think makes any substantial difference to the real content of the database, but it makes it harder to tie things in with real events. And also, we have a non-disclosure agreement with Cambridge that we'll ask people who are accessing this data to sign. So this is the data that we're making available. We include the following fields. Of course, for each trade, we outline the currencies that were actually traded. There's a slight issue here with trades in sort of unusual currencies. If a guy wants to sell Canadian dollars and buy New Zealand dollars, typically he'll have to go through two transactions going via United States dollars, because trades directly between Canadian dollars and New Zealand dollars are so illiquid. So what we end up capturing are two different trades there, but in the database that we're making available today, we just sort of summarize that as one trade in Canadian dollars and New Zealand dollars, so remove details of the component trades. We also store the timestamp, and as I said, that can vary in accuracy according to how the trade was done. We provide integer code saying who the market counterparty is. Typically, that's the bank that we're dealing with, which will be a large bank like UBS, Deutsche, people like that. We store their location, whether this was a deal that was done out of New York or London or Singapore. And we store the customer entity code. That'll be the string that we're replacing with an integer code, but that refers to the hedge fund or the insurance company who's ultimately doing the trade. And the market counterparty account just refers to the ultimate account into which the account is settled. Finally, we remove what we refer to as internal flows. These are just trades where our internal options traders are hedging their positions. These trades don't tell us anything about what our customers are doing. They tell us very little about what's going on out in the market as a whole. So it seemed safe to remove them. Now the guys on the desk will trade up to I think about 100 currencies. We're only releasing the trades in 10 major currencies. The reason for that is that the data doesn't really make any sense if you don't also have FX spot price time series to go with it. Just seeing the deals aren't very useful. You also need to know what was happening in the FX markets at the time. And it seems practical to offer price time series for 10 currencies. Doing it for 100 starts to seem unwieldy. These top 10 currencies account for sort of 95% of the volume anyway, so we lose little by removing a lot. Like I say, we're providing the FX spot price time series as well. We're not providing tick data of the type that Ewan was talking about earlier. Given the uncertainties about the accuracy of the timestamps in the deal database, that seems like overkill. So what we're actually providing a data sample to the 1 minute frequency. You'll get a sense from Ewan's talk about exactly how much data that removes. That's what's available. And the data that we're providing is not bid or ask or the mid price between bid or ask or anything like that. It's actually the last traded price in the currency in question. Okay, so that's the data that exists. Now I want to talk a little bit about how one might go about analyzing that data. What are the sort of questions that we as statisticians would want to ask? And why do I think this is a problem that's a machine learning problem, a high-dimensional problem? When I started working on this data, the thing that struck me most was that there was a very different way in which people in my type of role were looking at the data as compared with the guys on the traders who sit on the FX desk. I was thinking about it in terms of, well, here's all this information about recent customer transactions, and how am I going to build models around that to predict future currency directions? I wanted to look at the data in aggregate. The guys on the desk had a very different perspective. They were very interested in individual customers and what they can know about individual guys that they trade with. And the reason for this is actually when you think about what they do on a day-to-day basis, it's pretty obvious why. mean, if you're someone who's sitting on an FX desk and you've just done a trade in Australian dollars where you've bought several million Australian dollars from the guy on the other end of the phone, and within a few minutes of putting the phone down, you started to watch the value of the Australian dollar fall dramatically, you don't sit there and think, well, that's probably just a coincidence. I trade all the time. That sort of thing's bound to happen once in a while. What you think is that bastard knew something and I just got screwed. So the traders are particularly focused on finding out whether these people whether there really are people who show this sort of informational advantage, finding out who they are so that next time they trade with them, they can hedge the position before things head south. Now that's the sort of question that seems like a fairly straightforward question to answer. However, when I started thinking about it, it started to seem less straightforward. My first thought was, well, here's what I think I'll do. I'll take an individual customer, I'll look at the times at which he trades, and then I'll look at sort of an hour later, and I'll see how the price has varied over that hour. I'll look at the price delta over an hour or a day or whatever time frame we might be interested in. And I'll look at the distribution of those price deltas, and they should have a zero mean. And if we can reject the hypothesis that they have a zero mean, then we can claim that there's some information that the customer seems to have. That's what I thought. But it's not so simple. I mean, a test like that is based on the idea that the outcomes from each of the trades are independent. And we find that that's not the case because we frequently see customers hitting the market very, very, very frequently in sort of, there are lots of trades clustered around a very short time period. So we need to find a way of resolving that problem. There's also a problem with crosses. If we're looking at what a customer is doing in, say, trades in euros and USDs, then yes, you can look at his trades where he buys euros, sells United States dollars. But he can change his position in those currencies by going through other currencies. Maybe he's trading in euros versus Swiss francs, and then in Swiss francs versus dollars. So you've got to pull in that type of data too, and that becomes complicated. And finally, you've got a problem when markets trend. From that sort of naive test I just outlined, if you're looking at sort of a longer time periods and looking for people who have who show sort of this informational advantage over a period of a week or a month, then you find an awful lot of people have passed that test if they were trading in euros versus United States dollars during 2007, and that's not because they've got information, it's because the market moved in one direction throughout 2007. The euro went up in value enormously as the dollar collapsed. They were just trading in one direction all year long. There's no secret there. So there's lots of these sort of fiddly little problems to overcome. And I worked on it for a bit. And without going into any details of the analysis or the research, what you find is that there's not any real strong, significant pattern that you get out of this. And that's not really surprising. If you've got all this data, and if you're just looking at one customer's trades in one currency, and you know that 95% of this guy's trades are done with other counterparties anyway, and so you never see them, then you're very unlikely to see huge effects. So maybe we should be looking at sort of partitioning the data, looking at classes of customers, something like that. But the problem is that there's a multitude of ways of doing this. A customer might be good in some currencies and very poor in other currencies. Or maybe they're good at a time frame of a month, but very poor within the time frame of an hour. Maybe they do well around the time of major economic announcements. There's a release of data on non-farm payrolls in the United States tomorrow, and that's the sort of thing that always moves currency markets. So maybe there are customers who are very, very good with that type of data, very poor at other times. Maybe we should look at groups of customers and just consider hedge funds as a whole. Maybe we might find if we look at hedge funds as a whole, we'll find they're very good in, in flat markets, but not so good when markets are volatile. I don't know. Maybe customers based in Europe that do very well during standard European trading hours, but less well at other times. Maybe the traders aren't so alert at those times. Who knows? We can't test all of these hypotheses. There's just too much of it. So, given my background in speech and language processing, I started to think about this is a machine learning problem. Maybe some of the techniques I'd been using back when I worked in speech might be brought to bear here. Of course, there are key differences between this type of problem and the more sort of canonical machine learning style problems. The most obvious being that what we're dealing with here is temporal data. We're looking at time series rather than just trying to classify a static image. So if we are going to approach this problem from a machine learning point of view, what are the key questions that we should be looking to answer? And this is where I'm really looking for sort of input from people who are participating in the program on high dimensional data, because I don't claim to have any answers to these, and I'm very, very interested to hear other people's suggestions. It seems to me that the first question is, well, what, if we're going to sort of build a feature vector that we want to classify, what's going to go into that feature vector? Should it just contain all the information about recent customer trades? And if so, how do we turn that into a fixed length vector? One potential way might be to take every currency and every customer and look at, for every customer, the changes in their holding in every currency over the most recent time period, and look at, say, the last hour. But if you're looking at every customer, and there are several thousand of those, and we have 10 currencies, then that's a very large, albeit a very sparse data set. But maybe you can put in other things. Maybe you'd put in lag terms into that. Maybe you should include details about recent price movements in the currency market. Keep the information about the deals that were done, but also talk about about the differences in the price time series. Or maybe other features like volatility. Maybe we should include details like the particular time of day or the day of the week in our feature vector, so we can pick up things like the effects of economic announcements, which always, the major ones always happen on a Friday, and they always happen at 1:30 in the UK. Not the large US-based announcements happen at 1:30 in the UK. And we need to decide what we're trying to predict. Are we just looking to predict up and down market moves? And if so, over what sort of time frame? And maybe we should be looking to predict changes in volatility instead. Volatility may be easier to predict than changes in price. And finally, what type of techniques are most appropriate to this problem? As I say, it's very likely that what we end up with is a very, very large dimensional feature vector. Should we be looking to reduce that feature, the dimensionality with techniques like linear discriminant analysis? Should we be focusing on techniques that just do well with large sparse problems in general? And which techniques will work well with temporal data versus static data? Now, as I said at the start, this was never really intended to be a talk where I talk about my analysis or research. So I'm not going to really attempt to provide any answers to those questions. In fact, they're exactly the type of questions that we'd be interested in collaborating on and getting input from people who are participating in the program on statistical methods for high dimensional data sets. And I hope this has piqued people's interest, and if people want to talk to me about how they can get hold of this data, then please come and talk to me afterwards or drop me an email. So I just wanted to sort of wrap up the key points. We have this data set. People are working hard on predicting what happens to financial prices by just looking at previous financial prices. Here's some more data that we can throw into that might help us predict things better. This data set should allow us to have insight into our customers as well, and into the wider FX market. However, a sort of naive, narrow view where all you're doing is looking at one customer at a time is very unlikely to yield sort of positive results. So instead, I'm very interested in looking at this from a machine learning point of view and taking the data in aggregate. I think that sort of machine learning and pattern classification techniques could be very successful here. And that's, I think, all I have to say today. It's just a standard disclaimer. Hope you've got all that. That's all I have to say today. I'm happy to take any questions, of course.
Time for questions.
Why did you decide just on those 10 currency conversions?
They provide the bulk of the volume. They provide about 95% coverage. There's a really sort of sharp drop off in volume as you go past euro and United States dollar, which account for the bulk of the volume. Then Swiss franc, sterling, Japanese yen. After that, the trades are very, very illiquid in currencies. When you get down to sort of Mexican peso, things like that, there's just not so much. The feeling was that there wasn't so much interest in that, and because we need to ship the price time series as well to make the data worthwhile, interesting, then shipping 100 time series for those rather than just these 10 makes the data 10 times bigger and doesn't fit on a CD.
And what about other sorts of data trimming? All the customers kept in, or did you trim out customers that had fewer?
No, we've kept in all those. We've removed anything where it's just BNP trading with itself. But other than that, we've kept in details, I think, of all customers. I would need to check that, but I'm not. But I believe that's what's happened.
One more question. I didn't hear the time frame of the data. Maybe you mentioned it.
Oh, I didn't mention. You're absolutely right. It runs from the start of 2005 through to the middle of 2007.
Was this a data set that was kind of always being collected, and somebody later on had the idea of using it as a data set for machine learning on these objectives, or was it specifically started? The collection of the data set started as part of the.
I'm not sure what its heritage is. I don't. It certainly wasn't collected with a view to, well, let's use this for machine learning, but it may well have been collected with a view to this could provide useful information to algorithmic trading in general. I'm not sure. I mean, I think it's the sort of data that you would keep around anyway, but I don't know.
I got some questions about the data set.
Mm-hmm.
Do you have trades that go into BNP outside London hours in there? So, for example, are there trades with your American and Far Eastern entities in there? And also, how large is the data set? How many records in? How is it structured? Is it some sort of a SQL Server type relational database?
At the moment, there's a number of questions there. The first concerns are these questions. Are these trades just out of London? It's actually Paris where these trades get done rather than London for us, but or are they worldwide? The data that we've brought with us today and that we've left is only concerns trades out of the London office, London Paris office. But we are intending to release a different set next week, which contains trades from the US and New York and Singapore as well. So the number of trades is obviously a question that varies according to which of those data sets you're looking at. I think I can't tell you the precise number. The number I have in my head is of the order of 5 million trades a year, but I may be wildly off there, and I apologise for that. No, I think it's fewer. It's sort of 2 million a year. Sorry.
Just a couple of comments. I've worked with trying to design machine learning trading algorithms with a big market maker. And one of the problems that you encountered was clustering. That's because traders, whether they're market makers or prop traders, tend to take a big order or a big trade and split it into small trades so they come in small pieces. But using the kind of information that's in this database, when the aim is to trade, not to predict the direction of the market, because the key part of trading is actually when to stay out of the market. But using machine learning is actually pretty successful, and with a lot of caveats. But the customer information is, of course, the customer flows are very good. I was pleased to hear that your time stamping is more accurate than the ones that we've had. This was a bigger market maker, but a lot of the time stamping was just the close of play, because they were so busy they couldn't.
Right.
And so that's useless, as you pointed out.
Right, but you could presumably look at if you know the price at which the deal was done. You can sort of
that's right.
Maybe go back to when things were trading at that.
But that's a lot of work to
yes.
reconstruct.
Exactly. Yeah.
So 1 minute sampling on the real trades.
No, on the price time, so on the data that tells you what the rate was for euro, USD, or dollar, yen, or whatever.
So it's not exactly evenly spaced if it takes the real trades. Maybe
there's two sort of sources of data here. There's the database of deals where it's right, things aren't evenly spaced. Then there's the data that says these are the prices of euro, dollar, yen, euro, Swiss franc, etc. And that's sampled at a 1 minute frequency. So there's kind of two different data sets there.
And so if you're talking about that database with the timestamp and the price, You take the last price before this timestamp.
Yes, the last trading price before the
But it's not the timestamp
of the exact of the trade. No,
exact
no,
trade.
it's the trade that was done, the most recent trade before the one
Constant approximation.
Right.
Obviously, one of the areas that's important for our program is just having massive amounts of data that somehow have to be handled in a, well, from our point of view, from the academics' point of view, in a way that's got some formal justification, if possible. So it's the scale of the data that are the new thing that we're trying to look at.
Right.
Another aspect that often complicates things is if there's any element of missingness in the data set. Missing values tend to complicate issues. Is that a factor in this particular area?
It can be a problem in the price time series data. Ewan talked a little bit about the problems inherent in cleaning data earlier on. So yeah, it is a problem. I don't know what I'm not sure what the question is really. It's not a problem in the FX database, except the deals database, except that 95% of the data is missing because it's done with other counterparties. This is the data we have. We have to make the best of it.
My question was, is that data from the other parties missing at random in some sense, missing completely at random?
I've been treating it as being missing at random, but it probably isn't. If someone is working a very large trade, as the point that was made, it will be split between different counterparties, and so there are some deals that will be deliberately split up, and that's why data will be missing. So it's probably a reasonable assumption to treat it as missing at random, but in reality it probably isn't. I don't know. These are interesting questions that I don't at the moment know the answer to.
Whilst the arrival rate of trades is very high, over what period do you think it's correct to consider that data for estimating a future return on one of your currency assets? Is it arrival rate per second, and I think there's value in estimating a return over the next 5 minutes, 10 minutes, or 10 days?
My gut feel, and again I don't have good answers to these at the moment, is much less than an hour. I think is not likely to be worthwhile. Some of the currencies don't trade. The Scandinavian currencies and things like Australian dollar and New Zealand dollar that are in there don't trade at sufficiently high frequency to make sense to sort of predict what's happening over the next couple of minutes. It could be that there are some sort of hedge funds who are taking views that what's going to happen over the next 6 months to a year, and their trades may carry useful information in that. I'm not sure that the data set is actually long enough to be able to pick that out reliably. So I think, given that the data set only spans 2.5 years, and given the slight question over some of the accuracy of the timestamps, I think the sweet spot's probably between an hour and a week, maybe. Okay.
It's time to bring things to a close. I think the people in the Institute are very pleased that this day has taken place. Very grateful to everybody for coming along, to the presenters, and especially to Chris for setting it all up. Where things go from here in terms of the activity in the Institute, we'll just have to wait and see, but in 5 years' time, or perhaps 10 years' time, you can come back here and see a massive new building with all mod cons, or an existing building with to let. Outside. That'll tell you how it's worked out. As I said at the beginning of this session, if anyone needs to order a taxi, please ask at the reception desk, they'll set it up. And now or in a few minutes' time, there'll be some lunch available just outside. But, many thanks to Philip and to everybody else who's contributed. Thank you.